Hey guys, welcome back. In today's video, we are going to be talking about one of the most important ratios that Wall Street uses to analyze stocks and that I would encourage you guys to start becoming familiar with. It is called ROE, or return on equity. And I just don't hear enough people talking about it when they're looking at a stock or analyzing a stock or comparing one company to another. So in today's video, we're going to do just a very basic breakdown. What is return on equity and why is it so important? There will be two follow-on videos for those of you that are more interested in some numbers and math. In the second video, I'll show you some actual mathematical examples. And in the third video, we'll get into the DuPont analysis, which is even better than return on equity for looking at how well a company is utilizing its equity and its capital. So with that kind of framework set up, let's get into the basics. All of you guys can handle this. This is going to be a very easy video. Let's get right into the info. This video is designed for you, a beginning retail investor who is wanting to understand how is Wall Street analyzing and valuing my stock, and maybe what am I not looking at that I should be looking at. In my last video where we went over book value, you probably saw the quote where Warren Buffett says that they don't even use book value in analyzing and comparing stocks. Return on equity is one of his favorite ratios to use. So let's start off just by talking about why is return on equity so important and why should you be looking at it? First of all, it measures a company's profitability. Second, it measures the effectiveness of a company's capital utilization. Third, you must know if capital on the balance sheet, that cash on the balance sheet, is being effectively utilized or not, and return on equity will tell you that. And finally, by comparing a company's return on equity to the industry average for that sector, something may be pinpointed to you about the company's competitive advantage or its disadvantage if their return on equity is not good compared to its peers. Starting off with the very basics, what is equity? We're going to be talking about shareholders' equity in particular, and that comes from the balance sheet. So we need to make sure we understand, where does shareholders' equity on the balance sheet come from? And it comes from two buckets. We got our assets, which are, for example, things like cash, property, equipment, and inventory. And the other part of the shareholders' equity equation is the liabilities on the balance sheet. Things, for example, like accounts payable, leases, any debt that the company owes, and income tax payable, just to name a few. Once you have identified on your balance sheet the total assets, you're going to subtract the total liabilities line, and that will give you your shareholders' equity, which is also visible down at the bottom of every balance sheet. The other thing that we need to understand for this video on return on equity is what is net income, and that comes from the income statement, and it is very basically just your sales minus your expenses. Whatever you have left over at the bottom of the income statement is your net income. Now that we have those two items from the income statement and the balance sheet, we just divide. ROE is equal to the net income of the corporation divided by its shareholders' equity from the balance sheet. All right, Tony, fair enough. Seems like a easy formula. What does it tell us? As I have on the slides here, return on equity is a measure of a company's financial performance by comparing that net income to the shareholder equity. And it is considered a gauge of a corporation's profitability and how efficiently it generates those profits on the income statement. Return on equity denotes a company's capacity to return profits to shareholders, to us, and it indicates how efficiently a company is utilizing shareholders' funds. Because remember, at some point, all of those funds on the balance sheet, they started coming from us, from investors, and they get added, hopefully, as the company is generating profits. But we want to know that cash on the balance sheet, are you utilizing it well to generate profits or not. In general, what you should know about the ROE is the higher the return on equity, the better a company is at converting equity into profits. And over time, a rising ROE indicates that a company is earning more with the same capital. I want you to always compare ROE to companies in the same industry or in the same sector. It often doesn't work to try and compare company in one sector to another because they're going to utilize that capital differently depending on the type of business. And you should, for the company that you're analyzing, look at its ROE over time. You want to see, ideally, improving ROE. That's what Warren Buffett is looking for. Those of you that are familiar with my channel have probably seen this dashboard before, and I want you to note that return on equity there is on the top row, third from the right. This dashboard has key ratios that I use to analyze stocks, and the boxes will be filled in red, yellow, or green by the spreadsheet, depending on if we have a safe item there that we're analyzing or a risky item. Green is good, yellow is maybe problem, and red means we got some high risk on that particular item. You made it to the end, the very last slide on this basic video about what is return on equity. And we want to know, how can companies improve their return on equity ratio? The most easiest way, the thing that we're looking for them to do, is improve the net income, that numerator on the formula of net income divided by shareholders' equity. How do you improve net income? Selling more units, selling more inventory. Or you could get higher margin on the existing sales that you have, higher profit margin. You could improve your product mix to favor higher margin items and less focus on lower margin items. You could increase productivity gains or increase efficiency so that you get faster throughput on sales. You could have supplier cost reductions, which also improves your profit margin. And finally, you could reduce interest payments that you have every quarter or reduce tax-related charges. All of those would improve your net income. By improving net income, we improve the return on equity ratio, showing how much income the company is generating relative to the equity that's sitting over there on the balance sheet. You don't want to have a balance sheet loaded up full of cash, but you're not making any money. That is going to tell shareholders in Wall Street that you're not utilizing your capital on your balance sheet efficiently, and they're going to not give you a very high valuation for your stock. You're not going to get institutions buying your stock with a underperforming return on equity ratio relative to your peers in that industry. And why do we use this ratio, return on equity? Because we can all look at a company in isolation and see if their sales are improving, but that is in isolation. When we use this return on equity ratio, we then have a mathematical number that we can compare to peers. And we have company A, and they're growing their revenue, and we have company B, who is hopefully growing their revenue. But how well are they growing that revenue relative to the shareholders' equity on the balance sheet? This is the power of the ROE ratio. It gives you the ability to do that sort of comparison analysis. You can then use your screening tool, like I have Market Chameleon here, and pull up a sector. And you can see in the far right-hand column, we have return on equity, and I've sorted by ranking, showing me which is the highest in this sector on return on equity. And it goes down for several pages, all the way down to 0 or negative numbers on the bottom of the barrel. That is going to be it for the basic video here on return on equity. Just to get you started, I do encourage you to come back tomorrow or later this week and watch the next video, the level 2 return on equity. We're going to talk about some of the things on the screen here, how different corporate actions can affect return on equity. Things like debt financing, share buybacks, dilution, debt for equity swaps. I think it's good for you guys to know how each of those affect return on equity, because the corporations you're investing in might be taking some of these actions, and it could be affecting return on equity, which could be affecting how Wall Street is looking at your stock, and you just might not be aware of why your stock is not performing the way that you want, because you're not looking at things like return on equity. So if you are watching this video and that part 2 is already out, the link will be up here and in the video description. please give that one a watch. And if you're really nerdy and you really want to become an expert on analyzing these sort of things, come back for part 3, where I'll do the return on equity DuPont analysis, where we break down the formula a little bit more in detail, and we can look at different pieces of the business, how efficiently it is utilizing its capital. And this will really take your ability to analyze stocks to the next level. And I get it, for many of you, that is more work than you want to do, and that's fine. Just understanding this very basic video, these very basic concepts, is going to put you a leg up over your other fellow investors. So I hope you got some value out of this. Thank you for sticking around all the way to the end. I am Tony Denaro, and I will see you on the next video.